Right. Alright, so first thing you're looking at is you're looking at a chart of the S&P. I'm just going to go to an intraday chart. Now I want you guys to understand that in reality I am not a chart reader in any way. I am a tape reader. I just watch the tape and I build my biases that way. Charts tend to confuse me a little bit, so I just watch the way the market reacts to certain things. Alright, let's just clean something up here. There we go. Alright, I'm back. Alrighty, so right now you're looking at the S&P 500. We got some serious weakness coming into the end of the day. So it's kind of an interesting trade. Lots of people are getting really bullish, but we're getting some weakness and we get this kind of range. Now I want to point out, the action looking at it from intraday looks a whole lot like this zone where we get this and we kind of get this down movement and then down, and then we just fall down hard. So this kind of looks like the beginning of this movement down. So maybe if we can get another one, maybe even bigger, and hopefully we can get a VIX pop. Right now, a lot of volatility traders, as myself, which is part of my strategy. The other part of my strategy is pairs. We're all watching the VIX, which is the volatility index. Volatility is really low, so we really do need a pop in volatility. Hopefully we can get that pop pretty soon. But, you never really know when this pop is going to come, so we really do need a pop in volatility. Lots of people say don't go against the trend, blah, 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 blah. But in options trading, we're trading volatility. We're not actually trading the broad index, which is the SPX, or the S&P futures, which is what I watch. But we're not actually just trading this. We're trading volatility. We're trading the volatility. We're making assumptions on volatility in direction, but primarily volatility is how we're going to choose the trades versus a debit versus credit spread, or an iron condor, depending on the situation. If you want to take advantage of high volatility, you're going to want to be selling iron condors. If you want to take advantage of low volatility and hoping for a volatility expansion, you're going to be buying directional debit spreads or diagonals, which are also good. By the way, guys, we're going to talk about some diagonal spreads later. It is a debit spread that is a combination of a vertical spread and a calendar spread, which is a time spread. And what that does is you're hoping for a volatility expansion while also betting on direction. In a calendar spread, you're wanting the stock to basically stay and pin your strike while hoping for volatility expansion. Since we are bullish, we'll probably be doing a bullish diagonal or a bullish calendar depending on the situation of the stock, and we'll go through that. So we talked about the S&P. Next, we're going to talk more deeply into the VIX. Alright, so as you guys should know, VIX is volatility, right? And this is just a line just to show or kind of look how mean reverting volatility is as a product. And I keep saying this over and over and over again on every show. Is a very good strategy to fade volatility. Unless you're getting a huge up move, you have to be careful. And here you can really get hurt in moves like this. But say we're fading volatility and we keep selling volatility on pops. We may take in more risk, but look how hard and fast we get paid. Alright, so going back, volatility right now needs to expand. We really need to see a volatility expansion. And just draw out, we're very close to the lows here in volatility. And if we can get some sort of volatility expansion or a pop, we can get some chance to sell volatility. Now again, I don't really think the markets are going to crash and burn and die here, but I think markets are going to crash and burn and die. However, the markets really do need to mean revert along with volatility. So if we get something like this, or if we get below this area, it would be kind of interesting mean reversion volatility. Maybe we can get the VIX up to, sorry about this, maybe we can get the VIX up to There seems to be something wrong here. Alright, just a sec. Alright. So if we can get the VIX up to maybe 24, 25, that would be most interest to me. That would be the best possible case. And then you can start selling into volatility collapses. Selling iron condors, hoping for the SPY to stay in a range. Like, thing is that if you're selling iron condors in this index, the SPY has not been very accommodative for iron condors. It's only been staying within its expected move 68% of the time, and actually it ends up staying in the expected move like it's supposed to, but often it does not do what it's supposed to do. So again, hopefully we can just get a mean reversion volatility. Not a whole lot going on in the markets, but we'll go into some of the other markets. I have a pairs trade for you today that's actually very interesting, and you should definitely check that out. Let me just do a quick adjustment here. Right now I am going alone, so here we go. Okay, so going back right here, so we have a chart of SPY, and then you can only see a certain part of it. I get it, but we're going to move on to gold, or GLD or GC. I trade GLD because I only trade stocks. With the options, I can get enough leverage with the options. For now, I do trade the stocks with my kind of a quantitative perspective, or some different things I do with some of the quantitative stuff, but otherwise I mostly just am going to keep trading the options because of the leverage. But the future here on the Thinkorswim platform is GC, which is gold. Alright, so let this just load up. Okay, there we go. Alright, so as you can see, gold has been in a very large downtrend. You can see it falling and falling and falling and falling, keep falling. So we're getting this little pop, and then we're getting this down move, which was nice. This was an interesting area to short gold right in here for whatever it's worth on this big down bar where we're seeing, and then we get this little pop. So we're getting this small little pop. It's kind of interesting to see. I think it's shortable. Just kind of looking at the weakness of gold, I'm not extremely bearish on gold. It's kind of mid-range, but it would kind of be interesting to see maybe some lower levels coming into gold. It would be quite likely to see lower levels for sure coming into gold. And just alright, looking back to the daily chart. So, alright, there's a couple things you can do. You can short gold, you can do an options trade in GLD. You really can't do any sort of trade in the actual gold options because of the way the options work. It's not the best way. The CME doesn't support it like the SIBO is going to support the actual stock options market. So it's either you do a pairs trade, you do just short the gold futures outright, which is actually a very big contract, or you do maybe a stock pair or an options trade. So for me, it's either the gold minus silver pair. Alright, so you have, just a sec, we're going to get this to load up here. Come on, little program. There we go. Alright, so you get this pair, right? GC and SI have an extremely high correlation, and I'll load the pair chart up for you. You see they have a 0.9412 correlation, which pretty much means they move together 94% of the time. Alright, so you can short this pair, so if you're wrong, silver will hedge out your losers, and if you're right, silver will move on the downside, gold will move up, but you'll probably end up profitable if you sell more gold than silver. So I'm not going to get into the notional values of this, but because it gets kind of complicated and I have to go through the exact notional value of how to pair up all the futures. I'd rather not do that. So for me, there's a few things I might do. I might sell the gold silver pair, which I actually have done. I filled it in my personal account. Or what you could do is, just 1 second, let me remove my face because you won't be able to see it. Alright. So we're going to go to gold first. And in gold, they have, all these options. So what you can do is, considering the implied volatility, for me, I'm going to sell, and I'm going to set this up as a blast all order. I'm going to have to adjust my screen a little bit, but I'm going to set this up as a blast all order. So I'm going to sell the vertical, alright, and I'm going to sell a 2 strike wide, and then we're going to beta weight this. So we might as well just move to the Analyze tab so we can beta weight this. The reason for the Analyze tab is so I can just show you what it's going to look like compared to the actual gold trade. So we're going to sell a deep and wide 1 month 2 strike vertical spread. Alright, and then we're going to sell a silver put spread, and just let this load up for a second. Alright, so we're going to sell a deep and wide, sorry about this, 1 month 2 strike vertical. And the options are a little cheap here, which is kind of weird. So you're taking a little risk on that. So in silver, you may end up just buying a call spread. So what we're going to do is we're going to take this, and it's single symbol. We're portfolio beta weighting it. And we are not taking this. This is a paper account, by the way, so this will not be showing my real positions. And we're going to beta weight this to gold. Alright, so we're going to get kind of a sweet spot if gold hits 127.14, which is below, because gold is trading at 126.86, so we need the stock to get max profit. We need to go up a little bit. We'll make $37 this way, but before expiration you can make about $36 that way. Or what you could do is, if you want to get more bearish and hedge it more, you sell more of these. You sell 2 contracts and you get something more like this, which is more bearish. For me, it takes a decent $169 risk to make, at most, to make $209. So if you want to do a pairs trade that way, that's also an interesting way to do a pairs trade. If you want to see what the pairs trade looks like with just sell, and then silver, I usually buy a little more to be a little more non-directional. So instead, this is going to look very odd to you, but you're selling 50, you're buying gold, and then you're buying 100 silver. However, silver is a whole lot smaller than gold, so you're actually still short gold notional wise. And then if you beta weight it, beta weight the whole portfolio against, let's go with this, you get this kind of action. So you may want to hedge this up even more, so we could buy 150. For me, it's too big just to leave it like that, so you kind of get it more hedged this way. Alright, I just want to show you that. Personally, though, I try to get the notional values pretty close, or I just do an options pairs trade, which is still kind of an interesting one to do, just to show you guys. You can do that using the blast all order, and it's kind of an interesting way to do it. Alright, guys, so We just did a few things on the major markets and pairs trading. Now we're going to go on a short break. I hope you enjoyed the segment. Welcome back to Strategic Trading Radio Live. I'm your host, Alex Weisenbach, and I'm a 12-year-old stock and options trader. I am primarily a quantitative statistical trader. I base my options trades on option statistics, and I base my stock trades based off certain indicators I'm programming. Right now, I used to be more discretionary, but right now I'm just moving to 100% quantitative. So we're going to move to the next screen for a second, and we're just looking at the Analyze tab, and we're beta weighting a portfolio compared to everything. And by the way, guys, we actually have an audience here. We have an audience at the studios right now, so I'm not used to having a live audience all the time, so give me a little bit of slack, please. Thank you, audience. You're making noise. Alright, so first stock, I had to move a little bit out of my usual range. I had to move out of my usual trading, which is about 30 or 40 stocks that I watch on a pretty consistent basis. I have messed with the list several times to do a few different things, but I have to go out of that list right now because of the low volatility environment. There's not a whole lot going on right now in the markets, volatility-wise, so I'm having trouble finding longs that I can take. I don't want to have too much short delta on, so I have longs and shorts. It's kind of hard to have different longs and shorts on, though. Unfortunately, it's getting a little tough. So the first stock we're going to look at is a stock that I don't watch very often, or almost ever. I had to look at a chart at it, actually, because I didn't know where it was trading. But the first thing we're going to look at is Apollo. Alright, so to bring up a chart of Apollo, just 1 second. Let's see if I can get it up. Alright, we have Apollo here. So this is actually one of my short trades. I did short Apollo. Actually, one of my studies said it was bearish. So what I ended up doing is I sold stock and I sold puts against it. So I went out 42 days in September, and I was able to bring out I did the trade right about where this is still trading. So what you do is you go sell covered stock. You end up selling one put and selling 100 shares of stock. It says credit, but it's not really a credit because it's not measuring it correctly. One single order, you can reduce your cost basis about $1. So by expiration, if the stock is above $21.16, you'll be losing money. So you can cut off $1 of risk in there, increasing your probability of success. That was a trade I did. Now, for some of you, that may be too big. So a trade I like to do is you have to do this you cannot do this all as one trade. It is not supported by Thinkorswim, so it is something you guys should be aware of. However, what I sometimes do is I sell, let's say I sell a quarter of what this is. Alright, I sell 1/4 of what this is, and then I'm going to go ahead and check the delta, go to vertical spread, and I'm going to check the deltas, just to see how much risk I can get. So this delta, if I sold this, is -13, and this is long 25 deltas. So alright, so we can get our cost basis reduced here for the most part. So I'm going to sell vertical, except that I'm going to make it wider than this. I'm going to do this with a 48-cent credit, 2 strikes wide, single, and what is the deal here? Alright, just 1 second, guys. Yes, you're selling this. So actually what I'm tempted to do is I'm tempted to go 1 strike in and actually sell in the monies. Now this increases your cost basis, but again, there's some probability of success things. You still have exercise risk with this trade, unfortunately. So this is what this trade looks like. It's kind of a wacky covered stock position, but you're still short Apollo. You're taking up a whole lot less capital, but you can still reduce your cost basis about 74 cents. Looking at it, alright, so if I were to sell the stock, I'm probably selling it at 2015. I'm not taking the actual bid ask because the markets are closed right now. Okay, so you reduce your cost basis to 20.61. So you can get a decent little amount off by selling 25 shares of stock and then selling a call credit spread against it. It's kind of an interesting trade to do if you don't have the money to do the full trade, and you want to do a stock trade. Otherwise, what you do is, considering the situation, the stock you just go sell vertical spread, 2 strikes wide, 48-cent credit. Alright, that's not enough for me. Means you have to buy a put spread. Buy vertical, 56-cent debit, buy 2 strikes, sell out of the money, $126. Gives you a probability of success just around 60%. If I think about it, though, it is something like, well, you take 26 times, alright, so it is about, yeah, just around 60%, if you take the number. Each cent is worth 0.5%, 26 times half, you take that, plus the 1, which is 50%, and you can get kind of an interesting trade there. So it's right around 50% plus, you divide by 2, 13, so 63% exactly. 63% is your exact probability of success. So that's what you get for Apollo. I'm going to do one more stock and then I'm going to go on another break. Hope you guys find this stuff interesting. So I was talking about how appealing the VXX looks to me. So what I did is I was short the 14-13 put spread because I want to stay small. It fit better with my portfolio. Now I did 11 trades today, which is pretty usual. So of course my portfolio's moved around a little bit. Alright, so what I did is I already had this vertical spread in place. So I had the 14-13 short put spread. But what I did is I took the 13 and then I sold the 13-12, or maybe it was a 13-11. I think it was a 13-11. The 13-11 vertical spread, selling 13s, which I was long in the past vertical spread, and then buying the 11s, which gives me a higher probability of success, but more risk. So it gives me a little more risk and a little more upside, me wanting upside in the VXX considering how cheap it is. Now, understand you have to be careful because this ETF's toxic because of the downside drag. You have to be extremely careful with downside drag. However, Even so, I'm just hoping to get a quick pop. You can see some quick pops. And then if we get a pop in the VIX though, this ETF really will go up, because if we go back, take a look. This was a pop all the way to 21.78, almost 22. So if we go to VXX, we went from, in that period, we started going up from 18, we went all up to 23. We went all the way up to 23, decent return, I would say. So just selling a wide vertical spread is the most interesting. We have a high volatility, so we can do that. None of the other trades really look appealing besides an iron condor, but you can't get really wide in them. So I hope you enjoy this segment with some of the few stocks. Next few stocks we'll look at is BBY and UNG. Alright, I hope you enjoy this segment. We're going on another quick break. Welcome back to Strategic Trading Radio Live. I'm your host, Alex, and I'm a 12-year-old trader. I've been trading for 3 years since I was 9, and I primarily trade stocks and options with a quantitative trading approach. If you want to contact the show with any questions, comments, or technical issues, please send an email to strategictradingradio@gmail.com. And I'll just hopefully get that up for you in 1 second. Ooh, there's a big bee going on, so we're going to take care of that real quick. Technology people, please help. Nope. Alright. Alrighty, so the email should be up in just a sec. There you go. So if you can see right below, you should see the email, strategictradingradio@gmail.com. Alright, so we're going to go back into some of the few trades I'm looking at. So 1 second please, and we're going to switch over to BBY. We're going to also take a look at the chart on BBY. Alright, so seems like the chart's taking a minute to load. It's delayed. Alright, here we go. So this chart of BBY, BBY is just grinding up, grinding up, grinding up. If you're wondering, BBY is also known as Best Buy. Thing is, we have earnings in a few days. That's fine. That's fine. So we'll find the exact date for BBY, and we'll find the earnings. What else we can do is we can go. This is the 20th. So it has earnings in 11 days, but decent implied volatility. The implied volatility is, and the weekly is 11%, but we have 45% implied volatility. Lots of trading going on, extremely liquid. Alrighty. So for me, I'm bearish. I'm very bearish in the stock, so I need to find bearish plays. Alright, so since I'm looking for bearish plays, my first idea is a call spread. Alright, so you can sell a 2-strike wide call spread. You can sell this one for about 39 cents. If you want to widen out, you can do 72 cents. Probability of success wrapped around 60. I think it is 64%. You can get a probability of success just around 64%. Your cost basis is 37.72. And you can get decent profits, about 74 cents. Risk 124 to make 74 cents. High probability of success. Next trade that I'm looking into is, since, well, vol is decent, so you could do a covered stock position, if you're bearish, that is. So you sell covered stock, and then you get decent credits on this side. Yep, 154. You reduce your cost basis up about $1.50. High probability of success or higher. Max profit $218. Max loss infinite, but that's because you're taking a short position. It greatly reduces your risk, considering it reduces profit potential also, but again, it ends up reducing your risk, which is kind of an interesting trade to do. It hedges you out a little bit, gives you less exposure to the market. If you cannot afford a covered stock position, we'll go back here. If you cannot afford the covered stock position, what you can do is, we'll show you this on the Analyze tab. You have to do it as a blast all order, so you can't just do it as one order. However, what you can do is you can sell in BBY. In BBY, what you can do is you can sell a vertical spread, 2 strikes wide. We're going 2 strikes wide. You can sell that vertical spread, and then you can, it's the wrong vertical spread. We're selling puts, sell vertical, and then we're gonna go out to the 28ths. You get 74 cents exactly. Alright, so this is what it looks like, right? But then what we're doing is selling stock, except we're reducing this to 25 or 50 shares. So let's try 50 shares. It takes up $1,500 in capital, but then this put is going to reduce some of your capital requirements. And this is what it would look like if you were to do the 50. If you were to do 25, which is probably more, it gives you this larger risk. So let's say 75. So you get 75, here's your risk profile. If you want to do something a little different, you get smaller, you get way smaller. It reduces your cost basis a little bit less. It does reduce your cost basis less, but you can still make money if the stock goes up to 31.16 by expiration. You can still be profitable. You can hedge it out like this, sell 75 shares, or say you could sell something more like maybe 50 shares, and then you could do that. Or if you even want to get less risky, 25, but it increases this risk. So you can pretty much do it with 50 shares. If you want to do a stock trade, it's much more convenient to just sell a vertical if you don't have the capital to sell covered stock in this kind of trade. But if you really want to take advantage and get some decent time decay along with the bullish bias, so you can get more of a narrow trade, it might make sense to sell 25 shares of stock and then buy 25 shares of stock and then sell a call spread against it. But in this case, I'm not bullish in the stock, so this is not what we're going to do. And the next trade we're going to look at is a trade from Tasty Trade. They talked about this on Tasty Trade. It's an options trading and futures trading show that I watch personally. It's a really great show. You should check it out. It's all about statistical and math-based trading, so check it out. But this was a trade they were talking about also that I particularly like, and I'm going to fill it tomorrow. By the way, most of the trades I do here are trades that I actually do. So, alright. So the thing is, this stock is a commodity. So when commodities go down, they grind down and they shoot up. So volatility after the stock is down is really low. So what we want is we're going to get bullish in here, but we're going to hope for a volatility expansion. So there's a few things we can do, and I'll talk about which I prefer. So first thing is, you probably want the stock to go to 18, if I'm correct. Yes. So if we're bullish, we want the stock just to hit 18, for example. What you do, there's a 60% chance we get there, but what you do is you buy a calendar. Where did it go? There we go. You're buying the back month and you're selling the front month to show you what this trade looks like. in the Analyze tab. This is what it looks like. You want the stock between 1665 and 1925 by expiration. And this only starts making money by expiration. Hopefully the stock can hit $18 by expiration, and that's exactly where you want it. But this is kind of by expiration, so you really need to wait for expiration to happen. So you can do that, or you can do a time spread. So what that means is you're selling the, and you can do this as a diagonal spread, which would be right here. But I'm going to set it up one by one. Now this is called a directional diagonal. So what you're doing is you are selling this. You're selling the 18s here, which are the out of the money strike, and then you go to the back month and you're buying. And you are buying the back month in the monies. What this looks like is it gives you a direction. It's directional. You get a sweet spot right around 18 and you make the most money there, but you still get a decent profitability going into here because it's a directional spread. It looks more smooth on before expiration, but by expiration, near expiration is when you start making the real money. So you want to hold the spread. You have to be patient with these, but again, it's a directional spread, and hopefully you can get some decent profitability out of it. Alright, everybody. I hope you enjoyed this show. If you have any questions, comments, or anything to say at all, please email the email below, strategictradingradio@gmail.com. I hope you enjoy the show. Thank you for listening, and great trading.